You have worked hard your whole life. And if you're anything like the grandparents we work with, one of the things you think about the most is what kind of future you are going to leave behind for your grandchildren. There is a financial decision you can make today that your grandchildren will still be benefiting from 60 years from now. And that decision is starting a pension for them. In this video, I'm going to show you exactly why starting a pension for your grandchild is one of the most powerful financial decisions you could ever make for them, how a junior pension works and what it actually costs to open one, and why for grandparents with larger estates, it's also one of the most valuable and efficient planning tools available. My name's Chris Ball. I'm the CEO of Hoxton Wealth. We manage more than $4.4 billion for clients that live globally. And this is a question we see come up more and more as our clients start thinking about the bigger picture of what they want to leave behind. So section 1, how a junior pension works. A junior pension is simpler than it sounds. You contribute, the government adds 25% on top, and the money grows tax-free until your grandchild reaches retirement age. One of the things that surprises people when they first look at this is just how accessible it actually is. You can start with one with as little as £25 a month, and anyone can contribute. Grandparents, aunts, uncles, godparents, friends of friends, as long as a parent or legal guardian opens the account first. The account is called a Junior SIPP, a self-invested personal pension for children under 18. And you can contribute up to £2,880 per year. On whatever you put in, the government automatically adds 25% on top. You put in £100 and it becomes £125. Put in the full £2,880 and it becomes £3,600. That uplift happens before the money has done anything. The investments grow free of income tax and capital gains tax for the lifetime they're in there. At 18, the grandchild takes over managing the account and can make their own investment decisions, but the money itself stays locked away until the minimum pension age, which is currently 55 and rising to 57 in 2028. So that is what a junior pension is. The next question is what happens to that money over time, and this is where it gets interesting. Section 2. Time is the ingredient you cannot buy back. The government bonus is extremely valuable, but the real power of a junior pension is not the bonus. It is what time does to the money once it's in there. Compound growth, the eighth wonder of the world, but it can be difficult to feel the scale of it until you see a real number. So I'm going to give you one right now. If you contribute the maximum into a junior pension from birth until your child turns 18 and then stop completely, assuming 4% annual growth, which is pretty low, that pot could be worth over £580,000 by the time they reach 65. The total amount contributed to get there is around £52,000. That gap between what goes in and what comes out is entirely down to time. The decades between 18 and 65 are doing the heavy lifting, not the amount you've contributed. Every year the account goes unopened is a year of that compounding that cannot be recovered. The main reason it compounds so well is that you cannot access it. Remember, if you access the account and take money out, it will not compound at the same rate. With contributions and time, it's worth noting that the money can always be added later, but you cannot add time. So there is a compelling case for the grandchild. But for grandparents thinking about their own estate, there is a really, really good second benefit that's worth understanding too. Section 3, the inheritance tax angle. Contributing to a grandchild's pension is not just a gift to them. For grandparents with larger estates, it is also a way to move money out of your estate in a tax efficient way. A lot of the clients we work with have spent decades building wealth. They've been really diligent with their property, savings, investment, And at some point, the conversation changes from building it to thinking what's actually going to happen next with it all. Inheritance tax sits in the background of that conversation for a lot of people. The feeling that a significant portion of what you built could end up going to HMRC rather than the people you actually want to benefit is horrifying for most people. Contributing to a grandchild's pension is one way to address that, and it does two things at once. When you make regular contributions to a grandchild's pension out of your normal income, and those contributions do not affect your own standard of living, they can be treated as immediately outside of your estate for inheritance tax purposes, which is of course absolutely fantastic. This is under the normal expenditure out of income exemption. We talk more on this in another one of our videos on inheritance tax, which you can watch by clicking on the link in the description box below. So you're reducing the value of your estate today while building a pension pot for a grandchild that could be worth hundreds of thousands of pounds by the time they retire. That is a rare combination. It's a planning tool that benefits both generations at the same time. The specifics of how this applies to your situation depends on your individual circumstances, and this is a conversation worth having with a regulated financial planner before acting on it. So there are three things working in your favour here. Number one, the government bonus on every contribution. Number two, the biggest one in my opinion, decades of compound growth. And number three, for grandparents with larger estates, an inheritance tax planning benefit. Retirement is going to feel like a long, long way away when you're holding a grandchild for the first time. But that distance is exactly what makes this so powerful. The money you put in today has more time to grow than any contribution they will ever make themselves. What you're really doing them is giving them a massive, massive head start in life and in retirement. The kind of head start that changes what their retirement looks like and removes one of the biggest sources of financial anxiety people carry through their working lives. If you'd like to understand how this fits into your own plan, the link in the description will connect you with a regulated financial planner. Please subscribe if you like this video, click like, and thanks very much for watching.